Hi class, in this chapter, I'm going to go over in this video, I'm going to go over the chapters on monetary policy. So let's do a little review from what we learned from before. So this agency in government called the Federal Reserve. Remember, Federal Reserve is the central bank of America, right? And there's three main functions for the Federal Reserve in America. So number one is to ensure stability in the financial system, so which means by conducting all the banking regulation. Second is to supply all the money. So look at all the dollar bill you have. On top of the dollar bill, it says so right above the United States of America, above that it says the Federal Reserve notes, right? So the second function is to supply all the money in the economy. And lastly, and which becoming more and more important, is that Federal Reserve also conducts something called a monetary policy. So there are two type of policies that the government can use to influence our economic outcome. So one is called a monetary policy, that's for this chapter. There's one more called a fiscal policy, that will be for next chapter. Okay, so let's look at our monetary policy first. So for monetary policy, the key word here, monetary, like money, right? So monetary policy is really trying to influence our money here. So think about what is the value of money. Uh, let me say it one more time, right? So think about what is the value of money. Now you can say, hey, value for money is in terms of the other currencies. We can compare it to, Japanese yen, the Canadian dollar, Chinese yuan, to see if US dollar is becoming either stronger or weaker. But internally within the country, how do we look at how much is the value of the money? So there it goes down to something called an interest rate. So interest rate is how we look at what is the value of money here. So by definition, monetary policy is whenever our Federal Reserve um, influence how much the interest rate in the economy to influence our economic outcome. That is called a monetary policy. So when we look at our Federal Reserve here, so Federal Reserve, a couple of things to remember is first of all, Federal Reserve were divided by 12 regions, right? So there are 12 regional banks. And remember, the most important one is our New York branch of the Federal Reserve Bank. And also Federal Reserve, this Central Bank of America is very, very independent. So they are governed by the 7 board of governors. Each one serve a 14-year term, so longer than any president in office. Therefore, they can be very, very independent, very, very objective whenever they're acting any policy changes. So they're only acting in the best interest of the economy, the best interest of the country, not the best interest of any party control. Now, normally, we tend to think, hey, there shouldn't be any difference, right? So why wouldn't be that the government, the White House and the Federal Reserve want the same thing? But there are situations when this might be a little conflicts going on. So if you look at what happened to the end of President Trump's presidency, there was a little power struggle between the Federal Reserve and the White House. So President Trump want our Federal Reserve to increase more money supply, try to have a very, very good economy, or actually overheating economy, and then the Federal Reserve was worried about inflation. So White House want more money supply, and the Federal Reserve want less money supply. So there's a little struggle going on, and that's because our Federal Reserve is independent. Okay, and then don't worry, this agency is not a rogue agency in the government that nobody can check on them. There are many check and balance within the government. Okay. All right. So next, let's talk about what is the Open Market Committee. So the Federal Open Market Committee, this has 12 members. And for the 12 members, we have the 7 board of governors we mentioned earlier. So 14-year term appointed by the president, confirmed by Senate, and then plus 5 of the 12 regional bank president. So those 12 regional Federal Reserve banks, 5 of the president is also part of this open market committee. And then the New York branch, the New York president is always there. And then what this federal open market committee does, that they're gonna meet every month, and then when they meet at the meeting, they will try to decide what is the target interest rate in the economy is. And then once they have the target interest rate, they will they will come up with different policies, different approaches, try to move the economy toward this target interest rate. So so each members will ask them 3 questions. So first, what is your forecast for the U.S. economy? So do you believe the U.S. economy is getting overheated, which means the inflation is coming up, or do you believe the U.S. economy is going through a recession, which means hey, we might need some more money supply in the economy, right? So first of all, knowing what is the forecast for the economy, we can know what kind of policies, what kind of direction our policy going forward. So if you have an overheated economy, let's reduce our money supply, which means more interest rate. If you have an economy going through a recession, let's provide more money supply, which means lower interest rates. So first, you're gonna ask them, what is the policy? What is your forecast for the economy? And therefore, we know the direction of the policy. And then second, what are the right policy choices given the economic outlook? So there are different tools our Federal Reserve have to conduct these monetary policies. We're gonna go over those 4 tools later on in the chapter. So each members will come up with their own choices tools, and they will discuss what is the right choice, right policy for the economy at the time. And lastly, and very very important, is how do we communicate this plan to the public? So remember, the Federal Reserve, we have 7 board of governors, and also from the 7 board of governors, there's a chairperson, and that chairperson is appointed once every 4 years. So each president have the chance to appoint their own chairperson, and this chairperson have to deliver this final message to the public. So at the end of every monthly meeting, there will be like a news conference. So journalists, can ask questions directly to the Fed president, ask them about what the meeting was, and also the Fed president have to release the notes from the meeting. And once that notes is released, many investors, many banks, many financial institutions are studying those notes very religiously, very, very carefully, because any hint in the notes, they can point into a policy change that will cause a ripple effect in the economy, right? So that's why the last part here, how do you communicate the plan to the public, is actually very, very important in the economy, okay? All right, so next, let's talk about what is the goal for the Federal Reserve. So the Federal Reserve have 2 goals. The 2 goals are, number 1, try to have a stable prices, so which means low inflation. Number 2, try to have a maximum sustainable employment. Now, normally we're thinking, hey, these 2 are both good. Why can't we have both? And that's because within the economy, there's actually a trade-off between the inflation and also unemployment. So if imagine nothing else changed. So in a perfect economy, inflation is sending a message to all the company. It says, hey company, the reason why the stuff you sell is getting more expensive now, and that's because we like your stuff. Make more for us. So in a perfect environment, a little inflation can lead to a lower unemployment because companies are hiring less people. And then vice versa, if you have a very low inflation or even deflation going on. So with deflation, we're telling all the companies as, hey companies, the reason why the stuff you sell is getting cheaper now is because we don't want it anymore. And therefore company will lay off more people, right? So there's a trade-off between inflation and unemployment. And it's the role of our Federal Reserve to play a balanced game between these 2 outcomes here. So make sure I have a very stable prices, so low inflation. Also at the same time, try to have a maximum sustainable economy. That's maximum sustainable employment. Okay. All right. So for this, that means our Federal Reserve actually have targets for inflation and unemployment. And these targets, they tend to be pretty stable, but they do change from time to time. So recently, before pandemic, our target inflation is at about 2%, and our target unemployment was at about 5%. All right, so if you look at our target inflation, so for the last 10 years or so, we have been doing very, very good. So the Federal Reserve has done a very good job in controlling the inflation in the economy. So for the last 10 years, so ever since 2012, our inflation has been, holding below our target inflation of 2%. But that was all before the pandemic. So if you look at our inflation, since pandemic, this line looks like this. So especially like 2022, our inflation was close to 9%, 10%, right? So we're done pretty good before the pandemic, but the pandemic really threw everything off. Okay. All right. So why not have zero inflation, right? So what is wrong with zero inflation? So first of all, zero inflation, like I said before, a little inflation is good. A little inflation will give companies incentive to produce more goods and services, to hire more people. Second, um, that we need a little wiggle room for the Federal Reserve, right? So we want to have a low inflation. We want to lower the interest rate whenever there's a recession in the economy. But if you have a zero inflation, that means we have nowhere to go down now, right? So we can only move so far, so much down, and we cannot have a negative inflation, right? So we want to have a little wiggle room between our current interest rate and our market interest rate. So we cannot go below 0%. So having a little interest rate, having a little inflation, that's good, right? That give us a little room to move. And then number three, that if you have a zero inflation, then you might be running into the risk of deflation. Now, deflation means price goes down, and you might be thinking, hey, what's wrong with that? Who doesn't want the price to go down? Well, if you're a company, you don't want to see deflation, because for companies with deflation, that means you're making less money, and you're gonna lay off more people, right? So that will cause high unemployment with deflation in the economy. And also, lastly, the magic inflation tend to be overstating how much real inflation is. So that's why you don't want to have want to have a zero inflation, because the real inflation is not a zero inflation. Okay. All right. So there are four steps when the Federal Reserve is choosing this target interest rate. So first, the Federal Reserve will start with the natural real interest rate. And then the natural real interest rate is whenever our real GDP is equal to our potential GDP. So there will be zero output gap, right? So we learned from last chapter. So this is where the economy potential is. So zero output gap. So at a zero output gap, whatever that interest rate is, that is our natural real interest rate. So we're gonna set a target for that, right? So that's our target natural real interest rate. And next, we're gonna add the nominal interest rate on top of it to influence our real interest rate. So what the bank charge you for your loan, what the bank charge business for their loan, that's the nominal interest rate. And then the Federal Reserve try to target those nominal interest rate, try to influence our real interest rate, because the Federal Reserve cannot change the real interest rate. We can only influence the real interest rate by targeting the nominal interest rate. And then third, that we're gonna once you target your nominal interest rate and try to influence your real interest rate, we're gonna look at how much our inflation is. Right? So is our inflation meeting our target inflation? And if it's not, then we have to change our nominal interest rate again. And lastly, once everything's all set, so once the inflation is meeting your target inflation, the last step, we actually go back to look at, does our GDP fall in line with our potential GDP? So what is our output gap? And if your output gap is anything, more than what your tolerance is, then you have to change your targeted nominal interest rate, try to influence your real interest rate again. Okay, so four steps. Now, also knows a federal funds rate. So we talked about this last chapter. So federal funds rate is whenever the banks borrow money from each other overnight in a very short-term lending. That's called a federal funds rate. So banks do borrow money from each other on short-term basis. So imagine, let's say tonight, Bank of America is short for $10,000. Well, they will go to Chase, Wells Fargo, Citibank to borrow 10,000, but promise to pay the money back next day. So very short-term lending. But there's an interest around it, and this interest rate is called a federal funds rate. And this federal funds rate will influence how much our market interest rate is. So if the banks are paying a higher interest rate when they borrow money from other banks, then in return, they're going to charge a higher interest rate from the consumers. And then vice versa, if the banks pay a very low interest rate when they borrow money, they're also going to charge a low interest rate when they lend the money to the consumers, right? So this federal funds rate will heavily influence how much our market interest rate is. All right, so there's a formula for the federal funds rate. So your federal funds rate subtract inflation equals to the natural real interest rate plus half times inflation minus 2 and plus output gap. So this is a lot of number here. So I promise you, if you see this, you will only see it on the quiz. You won't see it on the test. Okay, so just something you need to know where to find it in your PowerPoint. So your federal funds rate minus inflation equals the natural real interest rate plus half times the inflation minus 2 plus the output gap. Now this seems like a lot of information, right? All right. So if you look at our rule of thumb, this federal funds rate rule of thumb, so we've been doing pretty good. So if you look at our rule of thumb, so this real simple calculation for our federal funds rate, actually very close to our real federal funds rate. So this rule of thumb is actually pretty accurate. All right, so next, so how does our Federal Reserve influence our interest rate? So first, remember the Federal Reserve does not directly set the federal funds rate. The federal funds rate, that's between each individual banks. So your Federal Reserve cannot tell the banks, hey, Bank of America, you're gonna charge a 10% whenever Chase borrow money from you. Fed doesn't do that. But there are actions from the Federal Reserve that can influence how much this federal funds rate is. So this is where the Federal Open Market Committee comes in, right? That 12-member committee. So this FOMC, the Federal Open Market Committee, they're the most powerful committee in the U.S. economy. Think this as the Justice League for the economy, right? Because the action of this committee here will influence how much our interest rate is. So what they will do, this committee will provide incentives for banks to either increase or decrease our supply and demand for loan in the federal funds market. And that increase or decrease supply or demand will change how much the actual price for money is. And that price for money is our federal funds rate, this interest rate that bank charge each other. So if you look at our effective, so with the actual federal funds rate versus our target federal funds rate, they are very much the same thing for the last 30 years. So our Federal Reserve has done a very good job trying to use our target interest rate, target federal funds rate to influence our actual federal funds rate. All right, so four tools. Number one, that we can influence our federal funds rate by charging interest on the excess reserve. Now we learned this in the last chapters that there is something called a required reserve. So how much money the banks need to have in the account. But however, if the bank hold on to too much money, so anything more than that is the excess reserve. Now, as a bank, you don't want to hold on to too much excess reserve because if you want to do too much cash in the bank, then you are not making any profit from the loans. But however, there are situations where the banks are hesitating to lend the money out, right? Because especially when there's no real profitable, investment or there's no real reliable investment, then the banks tend to hold on to the money. But for the money they're holding on to, this is the potential money supply in the economy that's not going out yet. So our Federal Reserve can actually force the banks to lend the money out. And when those money are lent out in the economy, that will increase our money supply, so more money in the economy, which means lower market interest rate. So we're going to do this by charging an interest rate for all this excess cash the banks are holding on to. Because remember, your Federal Reserve is the bank to all the banks. Now, for individual consumer, individual business, we don't deal with Federal Reserve. But if you're a bank in America, you have an account with Federal Reserve. So that account, that's where the excess reserve is deposited. So imagine the Federal Reserve says, hey, Bank of America, right now you have an extra $10 million in your account with me. For that $10 million, I want you to lend it out. And this is how I will force you. I will lower the interest rate to 0%. So for all this extra cash you have, the deposit with Federal Reserve, that if you leave it in here, you're gonna earn zero profit on it. And then what the bank will do, they will lend the money out to earn some interest from the profit, but this process costs more money supply, which means lower interest rate, right? And then vice versa. If we try to ever decrease our money supply, then the Federal Reserve can increase this interest rate on the excess reserve. So give banks incentive to deposit more money with Federal Reserve. The more deposit it is, the less money in the market, the lower the money supply, the higher the interest rate. Okay. All right, number two. So overnight borrowing by the Federal Reserve. So this federal funds market, that's when the banks borrow money from each other. Now, Federal Reserve can also play a very active role here. Federal Reserve can also go in there so Federal Reserve Bank themselves can also borrow or lending money in the market. So when Fed play a very active role in this, then this also change our interest rate in the federal funds market. Okay. And number three, direct lending by the Federal Reserve. So there's something called a discount rate. So federal funds rate is the interest rate between banks. Federal discount rate is the interest rate when the banks borrow money directly from the Federal Reserve, right? So imagine right now, let's suppose the federal funds rate is 5%. So when the banks borrow money from each other, then they will charge each other 5%. And then the Federal Reserve want to have a lower federal funds rate. So what do? Then the Federal Reserve can offer their loan at a discount, at a lower interest rate. So Federal Reserve says, hey, borrow money from us. We're only going to charge you 1% interest rate. So a lower discount rate will influence our federal funds rate to be decreased as well, right? So this federal funds rate, this discount rate can influence how much our federal funds rate is. And last, number four, and then the last action by the Federal Reserve, and this is the most well-known monetary policy tool, is to when the Federal Reserve is buy or sell government bond. So this process of buying or selling government bond can also influence our money supply. So buy bond. So when the Federal Reserve is buying bond from the companies, from the banks, from investors, they are paying money to us. So buy bond, increase money supply. And then sell bond, that will take money away from the public. That's going to reduce our money supply, right? So buy bond, sell bond will influence how much our money supply is. And this is the most well-known and most widely used tool our Federal Reserve has for the last 40 years to influence our monetary, to use as a monetary policy tool. All right, so this ripple effect. Whenever you have an initial change in the market, this will cause ripple effect in the market, and then this is also known as the multiplier effect. So for this ripple effect, imagine that we have a lower interest rate, a lower funds rate. So this lower interest rate will also change how much money our consumers want to borrow, right? And then so if the interest is low, we're going to borrow more money today. That will increase our consumption. And then vice versa, if your interest is high, they're going to borrow less money, and that will also decrease our consumption for today. And also interest rate will have an impact on the value of US dollar. So imagine I'm an investor. Let's suppose I'm an investor from China. And right now, if I leave the money in China, the Chinese central bank will pay me, let's say, a 2% interest rate. Now, but America pay me 5%. So what I will do, if America offer a higher interest rate, I will deposit my money in America. But doing that, I have to change my Chinese yuan to US dollar first. That means more demand for US dollar, and then more demand for US dollar, that will increase the value of US dollar. So a higher US interest rate will lead to a stronger US dollar. But let me give you a surprise that you might not hear this before. A stronger US dollar is not always a good thing for the US economy. And that is because we have import-export, right? Because a strong US dollar, that means everything produced in America just become more expensive now, right? So therefore our export will be worse off with a strong US dollar, and our import, right? So think about all the stuff that's made in China, made in Japan, made in Vietnam. If your dollar is stronger, that means we can use our US dollar, buy more good from China and Japan and Vietnam. And what that does, that will increase our import. So a strong dollar means lower export, increase import, and we're going to see a lower net export. And that's bad for the GDP, right? So a strong dollar is not always a good thing for the economy, okay? All right. So lastly, we have a couple unconventional tools for monetary policy. So first is called a forward guidance. So we've been using this tool for the last 10 years now. So is whenever our Federal Reserve um, actively advertising what is the strategy of future monetary policies. So instead of telling, so besides telling the public what we're doing now, we also tell the public what we're going to do in the future. So let's suppose Federal Reserve says in our monthly meeting, so when the meeting's over, they will say, hey, all the public, all the financial market, our Federal Reserve will buy more bond for the next 2 years. So that's a forward guidance, right? So that will change our expectation for the future interest rate. And next is called a quantitative easing. So this was very popular by the from the last Great Recession back in 2008. And what that does, that's when the Federal Reserve is actively buying not just bond, but also buying other securities from the financial market. And then one thing we bought a lot in the 2008-2009 recession is that our Federal Reserve becomes the biggest owner of our real estate bond. So think about all those mortgage that the banks give out. Now, at the end, bank don't hold on to the mortgage. They will sell the mortgage to a third-party companies, and then Federal Reserve become the biggest purchase for that. So when Federal Reserve is buying all the bond off the hand from the individual banks, that means they're giving the cash back to the banks, so banks can offer more lending, and that's called quantitative easing. Okay, and then lastly, also know that the Federal Reserve is a lender as last resort. So anytime when the banks are in trouble, they can always go to our Federal Reserve to borrow money, right? So you can think this as a bailout for the Federal Reserve, but what we try to do here is that we try to make sure we have a very stable financial system. We don't want the banks to go bankrupt because that will cause a big ripple effect, right? So that's why the Federal Reserve is also acting as a lender of last resort. When the banks are in trouble, they can always turn to our Federal Reserve to borrow money. Now, that doesn't mean that's a free money, right? So there are some, rules and condition attached to it. So think about what happened to the SVB Bank, right? So even though when the Silicon Valley Bank was on the verge of bankruptcy, that our Federal Reserve promised to guarantee all the depositor in the bank, but we didn't guarantee the shareholders of the bank, right? So if you have money invested in SVB Bank, so if you bought stocks for SVB Bank, then you are going to lose money. But if you deposit your money in the SVB Bank, your money was fully guaranteed. And remember, we have this FDIC for $250,000 guaranteed, but with SVB Bank, we try to stop any ripple effect. So our Federal Reserve, our Fed actually promised guarantee on deposit with no limit for the SVB depositors. Okay, so that's when the Federal Reserve is acting as a lender as last resort. Try to make sure I have a very stable financial system. All right, guys. So that's it for this chapter. Have any question? Let me know. Okay, see you later. Bye bye.